Happy holidays, everyone. My name is Doug Benjamin, and I'm the bank president in Spencer. I'm here with our guest speaker, Gary Peters with Winther and Stave, a local CPA firm in Spencer. I do want to apologize for my voice today. Been fighting a bug here, so hopefully I can make it through this whole thing. And then I should apologize for my facial hair. For people that know me are probably wondering why I would do that, as it doesn't look that good. So quite honestly, we're doing it for No Shave November. We're doing a fundraiser and to support our Relay for Life. So that's my excuse. You won't see it tomorrow, I promise. A few housekeeping notes here. I just want to thank you for joining our first of 3 webinar series covering various tax changes and how to prepare for your upcoming tax appointment. Over the years, we've done several webinars and in-person meetings to help educate the communities we serve. We are fortunate to have some great customer relationships at Northwest Bank and appreciate the opportunity to leverage them to share their various areas of expertise. We're excited to bring you our first seminar today on taxes for businesses. The next 2 seminars will cover taxes for individuals, and the final one will be taxes for farming operations. Today's live webinar is being recorded and will be shared after today's presentation, along with some helpful tips for you to reference. All participants have been muted, and we invite you to use your Q&A chat to enter any questions or comments throughout the webinar. We plan to answer questions during the presentation and also at the very end. So with that, I will introduce our presenter today, Gary Peters. Graduated from the University of Nebraska College of Business Administration in 1976 and started his career with Deloitte & Touche, a Big 4 accounting firm in Omaha. He moved to Spencer and joined Winther and Stave in 1978 as a staff accountant. Gary became a partner in 1984 and is now the firm's senior partner and has been the partner in charge of the tax department since 1984. His specialties within the firm include the preparation, planning, and consultation to businesses, individuals, fiduciary taxes, retirement planning, assistance in acquiring and selling businesses, mergers and acquisitions, wealth accumulation planning, and general client business consultations. Gary's made numerous public speaking presentations for statewide and regional organizations, as well as a smaller public speaking engagement on various business and tax topics. Gary, I will send it over to you.
Thank you very much, Doug. Appreciate the opportunity to visit with you today. And also want to thank Northwest Bank for sponsoring the program and giving us the opportunity to be part of the program. So thank you, Doug. Today's program will revolve around business tax planning. The next couple of sessions, as Doug mentioned, will be focused more on the individual side. And but just as a reminder, as we talk about businesses, when we talk about businesses, we're talking about businesses that may be a sole proprietorship, a single member LLC, a partnership, or an S corporation. Those entities have their income numbers all ending up on the individual return. So while it is not my goal to discuss individual taxes today, we will have to talk about them related to the business planning when we talk about those entities. So I think we'll start off today talking about what tax planning is and what we're trying to accomplish when we do tax planning. The primary thing in tax planning is to try to equalize income between years. We don't want what's called bubble years. We don't want a huge income in one year and a lower income in another year, because then we get distorted tax rates. We're paying higher tax rates on the bubble years. And so our goal is always to equalize taxes between, in this situation, maybe 2022 and 2023. So that's just the overall goal of tax planning. And what we'll do now for the rest of the session is talk about specific topics. And many of these topics probably deserve a 2 or 4 hour seminar in each one of them. But we're going to do an overview today. Be sure you take some notes if there's something of interest that pops for you, so you can visit with your tax preparer or your tax advisor. So again, we'll do a pretty global approach today on these tax topics, but hopefully be beneficial in the long run. As far as one of the items that we can talk about on the tax planning again is the timing of the income and the expenses. Again, most of us report on the cash method of accounting. So our income, we can kind of control when we get the money in as a business. And for example, we could defer billings if we wanted to slow down the income. We could accelerate billings if we wanted to build it up, and vice versa on the expenses. Again, on the cash basis, it's when you pay the bill, not when you incur the expense. So it gives us some pretty good flexibility as far as giving us an opportunity to put the income closer to where we'd like it to be. Next item, again, then, is so now we kind of get the income hopefully equalized between the 2 years. We have to be sure that we manage the tax liability. There's 3 types of taxes that we have to be aware of. Obviously, you have the federal income tax and the state income tax, but then you also always have to pay attention to the payroll tax. Because let's just say that we're a self-employed individual and we do decide to pay a bonus or something like that when we're trying to get our income in a position that we want. Anytime we generate some income at the proprietor level or generate a bonus at the corporate level, that carries a payroll tax with it. And that would be 7.65 employee share and 7.65 employer share. So that's 15.3% as an additional tax if we use some type of a compensation arrangement to accomplish our tax planning goals. So top rate of federal tax today is 37%. Top rate on the state income tax is 8.53, 7.5 on the Nebraska side, and then payroll tax is at 15%. So you can see that the payroll tax is a big piece, can easily be overlooked. So make sure when we're doing our planning that we consider the interaction between the federal, the state, and the payroll tax liabilities when we're looking at the tax situation. The next area I'd like to visit briefly about would be in the area of retirement plans. Retirement plans are very beneficial, but to say the first thing, if we do make a retirement plan payment for ourselves, those payments do not reduce our self-employment tax or do not reduce our payroll tax. So we have to keep in mind that when we do a retirement plan payment, that is a payment that would not reduce the payroll tax side. But on the retirement plan side, there's various types of retirement plans. The timing of your payment may be appropriate. When can you set one up? How much can I contribute? All those are retirement plan options we have to consider. I make an annual presentation up here in Northwest Iowa to a realtor group. And I've done that now probably for 5 or 6 or 7 years in a row. And this topic probably piques the interest of the participants as much as just talking income and expenses, because this is an area where they feel that they're in control. Usually it's a sole proprietor that is the realtor. So they find it very beneficial to set something like maybe a solo 401k plan that allows them to put significant funds away. And if you don't have the employees, then it diminishes that exposure to having to put money in for the employees as well. So this topic is always well received. And just kind of to hit a couple of the types we're talking about, retirement plans you may be familiar with, like 401k plans or SEP plans, simple plans, getting a little more sophisticated and probably used by people as they're getting close to retirement, maybe that in that 4 to 6 year range before you retire, would be the defined benefit plans or the cash balance plans. This allows you to put very significant sums of money away, but going along with that, if we do go that route and get those big deductions, we do have to make a commitment to that plan. On the 401k side or the other plans, there's voluntary contributions. There is no required contributions. But if we get to the defined benefit plan, then we're setting ourselves up for defined contributions that have to be made every year. So I think with that, maybe we can go to our first polling question today. What type of retirement plan does your business currently have? 401k plan, SEP plan, simple plan, don't have a plan, I don't know, not applicable, or other. So if you want to take just a minute to do that, again, let's just talk about the timing of setting these up while you're answering the question. The 401k plan must be set up before the end of the year, and we're already sitting here at the end of November. You could very well still set up an individual 401k for yourself, especially if you have no employees. You could accomplish what you needed to accomplish in the last 30 days very easily. But if you think about a 401k plan and you do have a number of employees, probably better to give those employees an opportunity to contribute throughout the year. So that might be one that you set up earlier in the year if we have employees to consider. So do we have the results of the poll? All right, 69% have a 401k plan. That is excellent. To me, that gives you the most flexibility and potentially the opportunity to defer the most amount of payment on the employer side, and also gives the employee a very significant opportunity to make contributions on his own behalf. So thank you for that, and let's move on then to entity types. This is planning that you don't jump into every year, but as you get started, or maybe strategically as you're going through the business life cycle, there may be changes that you want to make between the entity types. Okay, the entity types that are listed here is encompassing. It's the C corporation, which is a tax-paying corporation, and then we have the S corporation, the LLC, normally taxed as a partnership, and then we have the proprietor or the single member LLC. The last three items, all the income from those entities end up on your personal return, on your individual return. So like I said earlier, now when we start talking about tax rates, the C corporation has a flat tax rate at the federal level of 21%. But these other entities now, the S corp, the partnership, and the proprietorship, all those numbers flow through to the personal return and get taxed at your personal rates. So that's why we'll hit the tax rates here in a little while. As we already said, the top federal rate is 37%. On the first $120,000 of income on the personal return, you'll have your 12% rate. So that's kind of a feel for where the federal rates will be. And later on in the presentation, we'll visit a little bit about the state rates and the good news related to them. So maybe as we talk about these entities, switching from one to another can be a very significant decision. So there are tax consequences associated with any time you're dealing with the corporation route. If we're in a corporation and want to get out of a corporation, we have to worry about the fair market value of the assets that we're transferring around. Not the case with an LLC partnership, or not the case with a proprietorship. So I'm always a proponent of keeping things simple as long as it's accomplishing what we want to accomplish. And the LLC partnership model, or if you don't have a partner and doing it on your own, the proprietorship model, give you the most flexibility and are the easiest to work with. So I think here we've spent a few minutes getting started. Let's check and see if we have any questions at this point.
Gary, we have two questions. So I'll start off with one from your conversation about the retirement information. If you have a solo 401k plan, should you be trying to find a plan that has a Roth within that plan?
I would say that the 401k plan is a tax deferred arrangement to start with, and you are sheltering the income in the 401k. you can have a Roth component of your 401k. You can contribute to the 401k Roth component and not get a deduction for it as it goes in. So having the Roth option is always a good idea in the 401k plan, because then you have a decision on tax deductibility versus just investing on the Roth side.
Okay, thank you. All right, the other question was related to the different entities. Can I change from one type of entity to another without incurring significant income taxes?
Again, good question following up on what I mentioned earlier. Yes, switching from a partnership to a corporation is okay, going that direction. Going from a partnership and winding up the partnership and getting it back to the proprietor individual level, those transfers between partners and partnership are all very safe tax-wise. The dollars come out at basis and there's no gain or loss. But anytime we deal with an S corporation or a C corporation, whenever we try to pull assets or money out of there, once it's in there, there may very well be a tax consequence at the corporate level to get that money out. So it does make a difference and would be very worthy of discussion with your tax advisor.
Great. That's all the questions we have for now, Gary.
Great. Thank you. Let's move on then in the presentation to a very common year-end tax planning technique, and that is related to depreciation and fixed asset purchases. Many of you that have businesses are familiar with the terminology. I don't like to talk code sections, but Section 179 has been around forever, it seems like. That's the expensing provision. I remember years ago, $25,000 was the maximum Section 179 deduction, and now we're up to $1,080,000 per year as far as the amount that you can expense on your tax return related to 179. So that's been around for a long time. The advantage to Section 179 is that you can take any piece of assets and expense them. So if you buy a piece of equipment for $100,000, but your tax planning comes up and says you'd only like to have 50 or need 50, you can do that using Section 179. You can take the 179 on half and depreciate the half. So you have flexibility then in the amount of expense that you can take when we're relating to using 179 for our asset purchases. Bonus depreciation now has been around for a long time, ever since 9/11. That allows businesses to write off assets that they acquire, but the difference between 179 and bonus is you have to expense the entire amount of bonus depreciation in the tax category that you have purchased. So for example, if you have some 3-year computer assets and you want to write them off, you have to total all the 3-year assets and take bonus depreciation on all of them. That's the disadvantage compared to 179, where we could piece it out and get the number exactly where we might want to be. Keep in mind on bonus depreciation, that's 100% write-off yet through 2022. Bonus depreciation as we sit here today starts phasing out in 2023. Next year, you'll receive 80% of the bonus depreciation calculated amount, then followed by 60% and winding itself out then by 2027. So keep in mind that is here, still very valuable, but at this point does start ratcheting down starting next year. I made a note there on qualified improvement property. This is a defined term now that relates to improvements made on real estate that is commercial real estate and not residential real estate. But what a qualified improvement property category is, it's a 15-year property. So say you remodel the inside of a commercial building, as long as you don't touch the structural walls, all of the improvements are deemed to be qualified improvement property. They're not long-lived assets, they're only 15-year assets, and since they're 15-year assets, they qualify for bonus depreciation. So this is a very, very good way to get very significant write-offs on items that used to have to be depreciated over 39 years. Now we can get them written off in the year of the improvement. So a very significant difference there. The last item on depreciation I want to talk about is keep in mind that to get the write-off for 2022, the asset has to be placed in service. Now, what does placed in service mean? We get a lot of snow up here in northwest Iowa as we do across the Midwest. So if somebody buys a tractor, do you have to be able to go out and use the tractor in the field? No, but it has to be sitting on your farm ready to be used if it could be used. So let's just deal with that a minute as we're talking. Just take the farmers this year. I understand that farm equipment is hard to find. So for that farmer to take his write-off on a piece of equipment that he acquires or pays for before the end of the year, paying for it does not trigger the deduction. It has to be there ready to be placed in service. So if he just makes a down payment or pays for all of it in December and it doesn't show up until March, he does not get his deduction until it's placed in service. So that's why the placed in service date is very important related to depreciation and fixed asset purchases. All right, let's move on then to another category that's been around probably for about 5 years now, and that's the qualified business income deduction. All right, there's a deduction on your personal return. So again, I'm not talking personal taxes today, but this is where this deduction shows up, and it's related to income that may flow to you through your proprietorship, as a partner in a partnership, as a shareholder in an S corporation. Any income that when we total all those up for the year, any income that we generate from businesses then qualifies for a 20% deduction of the amount of that income. All right, so it's like I said, we've been working with this for 4 or 5 years now, getting the bugs worked out so we know how the system works. So just know that if there is income, there is a 20% deduction of that income that you can take on your personal return. Now, the reason I bring it up here as far as tax planning is if we run our income down too low, obviously this qualified business income deduction decreases at the same time, and this is a one-time deal. You can only get it in the year of the income. So we have to pay attention to that and make sure that as part of our planning, do we leave a little more income so we get this qualified business income at 20% and make sure that we accomplish what we're trying to accomplish in our tax planning. All right, let's move on to some reminders on our business travel. Keep in mind that for 2022, the standard mileage rate for travel is 58.5 cents. Normally, when it comes out at the beginning of the year, it's good for the year. But there's been 3 or 4 times during my career in accounting that they have come out because of significant gas price increases, and they've changed the rate. So for the first 6 months of 2022, the rate will be 58.5 cents. And for the last 6 months of 2022, the rate will go to 62.5 cents per mile. So you'll have to keep track of your travel expenses and split the miles for the first 6 months and the miles for the last 6 months. The other item that I want to mention is this is the last year for the 100% meal write-off. This was effective for 2021 and 2022. Keep in mind that goes back to 50% in 2023. So as far as keeping track of the meals and keeping track of the dollar amount for your tax preparer or your tax advisor, make sure that you're using the 100% number for 2022. Just a reminder again on business travel, you should be keeping business logs, travel logs related to the use of your vehicle or any business expenses that you incur during the year. Keep in mind you have to keep track of the date that you spent it, who you talked to, what you talked about, where you were, and all of those are necessary. And in your travel log, you have to say where you went, what topics were discussed, and who you visited, and all this has to be documented contemporaneously. That's the IRS's word for keep track of it as you go. So just keep in mind that anytime we're dealing with those travel expenses, those rules haven't changed for a long time. I just want to make a quick comment here on the business tax credits. There's a new one this year, part of the Biden tax plan that got passed related to green energy. Some questions have come up is, do any of our businesses qualify, or any vehicles in our businesses qualify for the electronic vehicle or the EV credit? And the answer is yes. It's a brand new credit. Like I said, I don't like to use code sections, but for your reference and referral, it's section 45W, and it's a credit for qualified commercial clean vehicles. That can be a credit of up to $7,500 per vehicle, and just wanted to make sure that's on your radar in case people ask you or it interests you in your business as far as usage of EV vehicles. So, all right, I think we're ready for our next polling question. How do you account for vehicle expenses in your business? Our company owns vehicles and pays the expenses. Employees are reimbursed for business use of their personal vehicles. We have no vehicle expenses, or I'm not sure, or not applicable. So let's just take a minute to log your answers to that question. Again, I just want to remind people that there's also new clean vehicle rules related to EV vehicles, electronic vehicles for personal as well as businesses. The parameters of those may very well get discussed in our presentations later within the next 10 days, I think Doug said. So just keep that in mind, because anything green oriented has a potential of getting favorable tax treatment, it seems like, after the last law was passed. So do we have results of our polling question? All right, pretty well split here. 40% says our company owns vehicles and pays the expenses, and 42% reimburse for the business use of the personal vehicles. Keep in mind, on the 42% answer, the use of personal vehicles, you have to have a plan, that accountable plan, where you have to make sure you report the appropriate information to your employer, and then you can get that reimbursement tax-free, and your employer gets a full deduction for the reimbursement. So, all right, with that, let's move on then to an item that's getting a little more press, and certainly an item that should at least be on your awareness guide. Pass-through entities and the entity payment of state taxes. A pass-through entity would be your partnership or S corporation. And why has this pass-through entity tax gained popularity? Well, as you're well aware now, for the last 4 or 5 years, our state tax deduction on our individual returns been limited to $10,000. That would be your income taxes, your real estate taxes, your car license fees. That total cannot exceed $10,000. So if I have a client that is living in Minnesota and has income allocated to him from that Minnesota business, or from the Iowa business, if he lives in Minnesota, he's going to have to pay an entity tax to the state where the income originated, and that got reported to him on his personal return. Historically, what's happened is he has got a distribution to make his tax payment. He makes the tax payment, and he's limited to the $10,000. What this flow-through entity tax has done, the government has said, we will allow states to pass legislation that will enable pass-through entities to pay the tax for the partner or for the shareholder. So, for example, if I'm an Iowa resident and I have some Minnesota income, we could make an election at the entity level to have the entity pay the tax, and when that tax is paid, then that is deducted on the entity return. And so what have I accomplished? I now have a deduction for my state income tax. Does not flow to my personal return, but just as a reduction of the income for that state that it applies to. Now, where it gets interesting is not all states have passed the pass-through entity tax. So I checked this morning, and we have 29 states that have passed, that have legislation in place that would allow the entity to pay the tax, the pass-through entity tax. I checked on Iowa, and it said that Iowa had a bill introduced, but obviously their session is over and no law was passed. So the bad news about this piece of the presentation is that Iowa and Nebraska do not have a pass-through entity tax. So we're still stuck with our $10,000 limit on our personal returns, but there are 29 states that have passed them. I have a number of Iowa taxpayers that have business income generated in other states that do have the pass-through entity tax, and we have saved our clients significant money by consulting with those out-of-state entities and making sure that we followed the pass-through rules for those entities. So just an item of awareness there in case you do have income from other states. All right, then let's move on now to the state income tax portion. I know I have listeners in Nebraska and Iowa, so I'm going to start going through a few of the changes on the Iowa rules that go into effect for this year and will be coming up in future years. So we'll talk about those, and then we'll hit a little bit on the Nebraska side as far as their rates are concerned too. So we talked about that qualified business income deduction before. That was a 20% deduction on the federal. On Iowa, that rate goes up to 75% of the federal deduction that you'll now be able to take on the Iowa return. It's been ratcheting itself up and will become 100% within the next couple of years, but just know for 2022, that's 75% of the federal amount. The other thing that you will find for 2022 is a very, very significant change in the state income tax returns themselves for partnerships and S corporations. Last year, both the partnership and the S corporation at the Iowa level was a two-page return. One, a summary of the income, and one, a K1 summary that summarizes each individual share of the earnings. If you'd like to Google this or check it out, just Google Iowa Draft Forms 2022, and you will see the new sets of forms. The partnership return and the S corporation return have gone from 2 pages to 8 pages, and the K1 reporting form for both the partnership and the S corporation is now 3 pages long. So if you're doing your own return, that's a very, very significant change in what you're going to have to do. And if you use an outside preparer or advisor to prepare your taxes, there's going to be probably significant more time spent filling out those 11 pages as opposed to 2 that we've had in the past. So just know that that's a very significant change for 2022. Also for 2022, we talked about entities that might have non-resident shareholders or non-resident partners. Iowa tax law changed for 2022, and now they have a composite tax return, which means the entity has to pay the tax for the individual shareholder or partner and send it into the government. So that's a way the government can make sure they get their tax money in case the individual, the non-resident, did not want to file. But on the other side, keep in mind that there's a very important form that I think we're going to use a lot, and that is an election out. There's a form that the entity can, or that the shareholder and partner can sign and turn into the entity and say, I don't want to be part of the composite tax regime. I promise to pay my taxes on my own. So you'll see that. It's a 1-page form, lots of small print. But the bottom line is that form has to be filed to allow a non-resident shareholder to not pay, to have his tax paid in at the entity level. Let's go to tax rates for just a minute. For Iowa C corporations, those are corporations that pay their own tax. The top rate for 21 and 22 was 9.8%, and that rate will go down to 8.4% in 2023. It will continue to go down based on the income collected on corporate returns for the next number of years. So it will continue to go down, but as we sit here today, we only know the amount that's going to be applied for 2023. Now that's different on the Iowa individual tax side. Iowa individual rate today is 8.53 for 2022 as it was for 2021. In 2023, that amount will go to 6% and continue to ratchet its way down till 2026 when the top rate will be 3.9%, and not only the top rate, but it will be a flat rate. So the Iowa income tax will decrease significantly over the next 5 years. Keep also in mind then, again, this is more of an individual tax topic, but the reason the rate goes from 8.53 to 6% in 2023 is that federal deductibility will disappear. So something that's been part of the Iowa tax regime ever since I started up here in the 70s was always a caveat that, yeah, but you got to remember that federal taxes are being deducted. That will not be the case for the first time starting in 2023. I told you I'd mention Nebraska tax rates very briefly. The corporate rate for 2022 is 7.5%. That will go to 7.25 in 2023 and ratchet its way down to 5.84% in 2027. And then on the individual side, there was no change. In 2022, the top individual rate is 6.84%, and it remains that way for 2023. All right, so I think that concludes that. Let's take maybe another break for some questions.
Sure, we've got a couple questions here, Gary. Start with a few slides back. Can I pay myself a salary at the end of the year?
It's a good question. The payment of the salary can be made at any time. You just have to make sure that you are doing the work of an employee at some time during the year, and whether that then is paid weekly or biweekly or monthly or once a year is certainly okay. So it's more making sure that you are an employee and not when the payments are made.
Thank you. Then there is another question here. You had just talked about the step down on the state taxes from 8% down to 6% and so on and so forth, but there's no deduction on the federal. What's the net impact on that to the business? Is it a positive?
Okay. It can be positive for some and it can be negative for others. Okay, it sounds like a typical accountant answer, but for the larger, higher tax paying people, I feel this will be a detriment. They got more benefit out of the large federal tax deduction than they will get out of the reduced rate. So for the high income taxpayers, I think it will be a detriment. I would say for middle and low income taxpayers, it may be a neutral because a lot of those tax rates historically have been between 4% and 7%, and our first step is down to 6%. But after we hit that 6% and start ratcheting below that, it will be definitely more beneficial for the middle and lower income people.
Okay, great, thank you. One last question here before you return. With both individual and corporation tax rates decreasing in the upcoming years, does it make sense to defer income to those years and accelerate expenses to the current year?
Another good question. That would logic out that if the tax rates are lower, you would defer the income. Just be careful that we're talking state rates here. Okay, so a 1 or 2% decrease in the state rate may be dwarfed by the impact on the federal side of any taxes paid at that level, maybe at a higher rate, or maybe the deductibility of the items over there on the other side. So it could be that way, but make sure you consider your payroll taxes and federal taxes we talked about earlier, and not just rely on that state tax increase or decrease.
That's all the questions we have for now. Thank you for the questions. Keep them coming.
Okay, good. All right. I want to wrap up with a couple of items looking forward. So if we would like to just take a minute and talk about an item that's been released probably in the last 6 months, but has nothing to do with income taxes, but certainly has something to do with businesses. And this is called the Rule for Corporate Reporting of Beneficial Ownership. That's a mouthful. It's called BOI for short, Beneficial Ownership Information. And this has to be filed due to a ruling by the Treasury Department and FinCEN, which is the monitoring of transactions in the banking world. This originated because of potential fraud and money kiting and money laundering and this type of thing. So what we're having to do now is, starting in 2024, we will have to report to the government for any entity that has a 25% or more shareholder. We will have to report name, ID number, information related to every entity and every entity that has a 25% or more shareholder. So we're always concerned about what the government knows about us. And yes, they do see our K-1s, but this is something that they'll put in a separate file, and they'll make sure that they keep track of that. So that starts in 24. And the due date for doing that is for any entity that was in existence on 1/1/24 or prior. You have to report sometime during the 2024 year. So you have a 12-month window to complete that first filing. The second, let's just say we have an entity that's formed after 1/1/24, they have to report within 30 days of forming their entity. Okay, and the last tier would be any entity either pre-1/1/24 or after that date that has a change in ownership that affects the 25% or more shareholders. They're required again to submit that information within 30 days after the change takes place. So again, has nothing to do with income taxes. The good news here is it's a one-time reporting unless you change. The other good news is at this point, I see no fee associated with that filing, but it's just one more thing that we'll have to be aware of as 2024 rolls around. The last item I want to spend just a little bit of time on today is using our crystal ball and saying what's going to happen out there between now and the end of the year. We have a lame duck session now is what they're talking, what this is called, between Election Day and the new Congress coming in 2023. And there may be some things, a lot of times during this period is tax extenders come into play. These are about 20 or 30 laws that get changed and revised and adopted every year. So we'll have to see if there's some extender legislation that comes out of this. The other item that gets a lot of talk right now is the child tax credit. As we were aware during COVID, we had some very, very beneficial tax rules related to child care and very significant credits related to that. The Democrats would like to push that piece through to some extent, and maybe on the Republican side, the exchange would be, we already talked about bonus depreciation starting to ratchet down to 80% and on down to 0 over the next 5 years. Maybe that would be reinstated at 100%. And then for the businesses that do have significant research and development expenses, that's the other one you may have heard in the news. Those companies that have that used to be able to write off all those expenses in the year that it was incurred. Now it has to be amortized over 5 years, and that might be another give and take to get that 1 year write-off instead of the 5. The only other item I think that could sneak through in the tax law is some more retirement changes. It's called Secure Act 2.0. This again would extend the amount of time before you have to start taking your distributions out of your retirement plan. And there's probably 20 or 25 provisions related to retirement plans that does have support of both the Democrats and the Republicans. So there's a potential to get that passed. But again, we're only down to 31 days now, and a lot of times this gets passed right before Christmas, so we'll just have to pay attention and see. So I think that is my roundup on business taxes and some tax planning ideas for the 2022-2023 year. I'd like to thank you for your attention during this presentation, and one more time, thank Northwest Bank for sponsoring the seminar.
All right, well, thank you, Gary. It doesn't look like we have any more questions in the queue, but again, just want to thank you for that great information. Who says accountants are boring? Taxes aren't fun, but this seems to be one of our best events. It's a interesting time, just trying to figure it all out and do your best to minimize your taxes. So again, thank you for that. Also want you to look for email coming. It'll have the recording of the presentation. That'll go out to all the registrants for today. And then any follow-up material that Gary will provide. And I think we got all the questions answered, so should be okay there. We would also ask, there'll be a survey that comes, and we would appreciate your feedback and include areas of interest you would like to learn more about, so that we can continue to provide good information to our communities. Thank you again for joining us today, and that concludes our webinar, and we encourage you to sign up for December 7th for our individual webinar and December 8th for our ag webinar. Thank you.